Hello, everyone. I hope everyone's doing well. Today, I will be talking about valuation. And this is kind of the culmination of the first 8 videos of my lecture series. Today, I'm really going to be talking about how we are using these principles of cash flows and risk to value businesses and assets as a whole. So, first, what is valuation? So, valuation is the process of determining the value of an asset or company. And valuation is incredibly important to us as investors. Smart investors seek to invest in assets where the price at which the asset is selling for is below the true value of the asset. And this is called value investing. And this is just kind of like how we behave in everyday consumer situations. If we want to buy a house or a car or just like a grocery item, we're always trying to buy things at a price that is less than the actual value of the object. And of course, the value of any asset is the present value of its future cash flows. I've been saying that sentence throughout this entire lecture series, and it still remains true. So first, I'm going to talk about enterprise value and equity value, which are the two main things that we're trying to value when it comes to a business and its equity. So first, I'll start out with this little house analogy. Let's say I have a house where I have a 500K mortgage, and on the open market, my house sells for $1.2 million. And my house has 200K in cash inside of it that comes with it. So first, what is the value of my equity in the house? Well, the value of my equity in the house is just whatever I sell the house for, 1.2 million, minus the mortgage that I would presumably have to pay off. So it'd be 1.2 minus 500K. And then whatever I have left over is whatever the value of the equity is, which is 700K. If the house were to go up to $1.3 million, then the value of the equity would now be 1.3 minus 500K, so it'd be 800K. So it's just the residual amount that's left over after I pay off my mortgage. And then what is the value of the house standalone? Well, you would think, oh, this is 1.2 million. That's what it sells for. Well, that's what the house is selling for, including the cash inside it. But without the cash inside the house, what is the house really worth? And that would be just $1 million, right? Because it'd be the 1.2 million minus the $200,000 of cash that's inside the house. That would give you like the true value of the house standalone, not including anything like cash inside of it. So yeah, that's what I would say the value of the equity, the value of the house is. And we can kind of use this formula to represent this. We could say the value of the house, just any house in general, is equal to the mortgage plus the equity minus the cash inside of the house. Because the mortgage plus the equity gives us like the total value of the house, the value of the house, where what it would like sell for on the open market, right? So $1.2 million. And then you have to subtract out the cash, right? Because that's inflating the value of like what the house is selling for and not actually representative of what the house is really worth. So once you subtract cash, you'd be able to get to the true value of the house. And this is very similar to how we look at companies. When we're looking at companies, oftentimes we're trying to value just the entire company and its core operations as a whole, or we're trying to value the equity of a business. So we also use this formula here. When we talk about valuing a business, this is called enterprise value, just the value of a business. So enterprise value equals debt plus equity minus cash, right? Because cash, which oftentimes is inflating debt and equity, because debt and equity holders sure do get value from a company just having cash on its balance sheet. But that cash on its balance sheet is not contributing to the actual value of a business, right? And you can see this formula is very similar to this formula here. So I'll keep elaborating on this. What actually is enterprise value? Enterprise value is the value of a company's core business operations. So pretty much the value of a business's core operating assets. Key to realize operating assets. Non-operating assets like cash or parcels of land do not count toward the value of a business. And then, of course, the definition I've been giving throughout the lecture series, it is the present value of a business's future cash flows. So you can kind of think of it as it's the value of a business's operating assets. And of course, these operating assets have value because they're producing these future cash flows. So the total value of a business is just the present value of its future cash flows, right? And we can calculate the market implied enterprise value of the firm using the following formula, the formula I just gave, similar to how we're looking at a house. Enterprise value equals the market value of equity plus the market value of debt minus cash. That same principle of why we're subtracting cash. I know it's not really intuitive to subtract cash because you might be like, how is getting cash really decreasing the value of my business? Well, technically, it isn't decreasing the value of your business. If you were to just find $100 of cash on the ground, then that would actually increase the value of your equity by $100, because now that cash could go toward like paying equity a dividend or something that would, equity holders would realize value from, right? So equity would go up by 100, but then your cash would also go up by 100, and these would like cancel each other out because one's being added and one's being subtracted. So overall, they would net each other out, and there would be no effect on enterprise value, which is how it should be, right? A business paying a dividend or finding cash on the street should not affect enterprise value because it's not affecting a business's core operating assets. So I'll go a bit deeper into what equity value is now. So equity value, or the market value of equity, is just market capitalization, right? Shares outstanding times share price. And it can be seen as the value of everything a company has that belongs to equity holders. And we can kind of rearrange this formula to put it like this: enterprise equity value equals enterprise value minus the market value of debt plus cash. And remember that equity value is the residual claimant of a business's future cash flows because of the absolute priority rule, which is a bankruptcy law rule, where debt holders can have to get paid out before equity holders. And that's the reason why when I was doing the calculation with the mortgage, you subtract the mortgage first, and then that is what your equity value is. The bank is always going to get paid back first if you were to sell your house. You can't just sell your house and take whatever there is and only pay back the bank a little bit. The bank has to get paid back in full before you can realize any value from selling that house. So yeah, equity value is the value of everything a company has that belongs to equity holders. So it's not just the operating assets, because certain things that are not included in the value of a business's operating assets do increase the value of equity, right? Like if a business just owns a non-operating asset, like a parcel of land, they could, lease out that land and get some money from it. I mean, that wouldn't be a part of the business's core operating assets, so it wouldn't go toward enterprise value, but equity holders could still get money from that because they could get like a dividend or a share buyback or something that they could realize value from. So it's important to realize these definitions, equity value and enterprise value, are not really close to the same thing. And it's pretty nuanced actually, because equity holders can derive value from things that are not just business core operating activities. And of course, enterprise value only increases when the value of a business's core operating activities is increasing. So I'll now talk about the market value of debt. And the market value of debt is simply the price that a company's debt is currently trading at. And we're doing the market value rather than the book value of debt, which is just the value at which debt was originally issued at. And this more accurately reflects the current riskiness of a business's future cash flows, right? A company that has debt trading at 50 cents on the dollar, half of face value, has riskier cash flows, and therefore the business is not worth as much. So this is important to reflect in our calculation of enterprise value, right? You have to, reflect the fact that the business has become riskier. So now the debt isn't actually worth as much as it previously was, because the discount rates have gone up for this business, and therefore the debt is not quite worth as much, right? Because we're kind of doing these shortcuts to find the value of the enterprise, but there actually is like a fundamental way to do that, which I'll talk about here, right? So we have this equation visualized. You have the enterprise value equal to the market value of equity plus the market value of debt minus cash. And you can see by this picture on the right, I'm kind of just shuffling everything around. I'm just moving cash to the other side of this equation algebraically. So I'm saying enterprise value plus cash equals the market value of equity plus the market value of debt. And you can think of cash as cash and other non-operating assets, right? Anything that's a non-operating asset, including cash. So you can kind of see this is kind of like a market value balance sheet. You have all of the assets, operating and non-operating, on the left side, and then all of these claims on these assets, whether it be debt or equity, on the right side. So you can think of the right side as representing the claims on a business's assets, and the right side is moving in response to what happens on the left side, right? If a business is doing better and the market value of operating assets, the enterprise value, is going up, then that's going to affect equity, right? Or if cash goes up, that would also affect equity. The market value of debt is usually going to remain pretty stable unless there's a weird macroeconomic situation or a company just becomes a lot more risky. But the market value of debt would really only start to go down substantially once the value of equity is pretty much wiped out. It's kind of like, because equity is the residual claimant and is incurring so much more risk than these debt holders because they get paid out last, unless the equity holders are pretty much wiped out, debt holders wouldn't really start to incur losses yet. It's basically the analogy I give is it's like being on the Titanic. Until second and third class, which you could think of as the equity holders, get wiped out, the first class people on the Titanic won't really start to get flooded yet. You'll see this principle in a second. So here's like an example capital structure. We have cash is 10, market value of operating assets is 85, so enterprise value is 85, and market value of debt is 50, market value of equity is 45. What happens if the value of business core operating assets go up to 135? Well, as you could probably guess, the equity went up as a result, not the debt, because equity is the residual claimant and therefore receives all of the upside here. We're assuming right now that the book value of debt is 50, so the debt is trading at par. So that wouldn't really go up when the value of the business starts to become a lot better. It's kind of like the principle that you would rather invest in Amazon's equity in 1995 than their debt, because equity would receive all of the upside of the business doing so well now, where the debt holders would just receive their interest payments and then go home, essentially. They wouldn't really receive any upside from Amazon becoming a much better company. They just got paid back, which is basically what they expected. So yeah, so that is what you can what would happen there. Equity would go up. And what about if the core operations or enterprise value went down to $60? Well, same thing here. Equity would be the ones getting punished for that. That would still remain at 50 theoretically. It would only be equity that's really going down as a result. But if they really start to go down, enterprise value, the value of the operating assets goes down to $15, perhaps the debt would start to trade lower. Perhaps it would trade at like 50 cents on the dollar. And as you can see here, it's trading at half of what it once was, 50. So it's trading at 50 cents on the dollar. You might be wondering, Carter, why does equity still have value here? You would think that equity would be zero now if debt is starting to, get flooded into, right? Because if debt's not going to get paid out in full at 50, then equity should have no value. That is true. But as you'll see in real life, stocks never trade at like 0 cents exactly. You can always buy them for like 10 cents or like 30 cents because there's always a chance that the business can recover and you'll get like a really big return from it. You're just investing in like a super risky asset at that point because there's potential that you might reap like a massive reward from it. So how do we actually calculate enterprise value? And this is what I was alluding to earlier. There's one kind of shortcut way, which is if someone was like, hey, Carter, what's the enterprise value for this company? I would just tell them what the market implied enterprise value is. Similarly to like if someone asked me the value of a stock, I would just tell them what the market cap is. I wouldn't tell them what I actually think the value of the stock is. I would tell them what it actually is right now based off, what the market is implying. Because, it is the enterprise value is the value of business core, operating activities, but we're usually just looking at what the market is thinking, right? So we can just use the formula EV equals equity value plus market value of debt minus cash. But if we actually wanted to value business ourselves, which is the entire point of valuation, we can do so either doing an intrinsic or relative valuation. So perhaps I'll give a little example. So perhaps Carter has an enterprise value of $1,000. EV equals 750, or EV equals equity value, which is 750, plus the market value of debt, which is 300, minus cash, which is 50. And I decide for whatever reason that I want to value the company. And after doing a valuation, I decide its enterprise value should actually be 1,200. And therefore, I subtract debt, which is 300, so 900. And then I add cash, which is 50, so 900 to 950. And I say, okay, the value of the stock is 950. It's currently trading at 750. I should buy this stock because I think it is undervalued. So you can see here this principle of valuation. By getting the enterprise value for a company, you can see what the value of its stock should actually be by just subtracting debt and then adding cash. It is very common when you're doing like a DCF, which is a discounted cash flow analysis, which I'll talk about in future videos. So as I mentioned in the last slide, intrinsic versus relative valuation. There's two main ways for us to value businesses or assets. Intrinsic valuation is just valuing a company simply based off of calculating the present value of that business's future cash flows, right? And that's what I've been talking about like this whole video lecture series. So if you were to calculate the intrinsic value of a house, you would just calculate out the present value of the future rent payments for a house. Because those would be like the cash flows you would get from owning a house. So this would just be projecting out all the money that I would make and leasing out my house into perpetuity. So that just means like into forever, right? Even 100 years from now, you could still hypothetically still be making money from this house. So that's how you would like calculate the value of an asset or a company intrinsically. And then relative valuation is valuing a company by comparing it to how other similar companies trade. So rather than just focusing on your company and intrinsically how much cash flows you could derive from it. You're just looking at how other companies trade and extrapolating that to get the value of your assets. So for instance, maybe I want to see what my house is actually worth. And this is probably the more practical way that people will actually, value houses. You just find similar houses that are made of similar materials in similar areas, and you just extrapolate that to find the value of your house. So maybe a 4K square foot house in my area sold for 400K, a 6K square foot house in my area sold for 600K. So I can say, okay, my house is 5K square feet. Maybe I could, say it's worth $500,000. That seems like a realistic estimation based off of these comparable houses that I'm looking at here. We can see that in this area with these materials, these houses seem to be going at 100x their square feet. So if they have 5K square feet, they'll sell for 500K. Maybe in a different area, like on the lake, it would, instead of being 100x, it would be like 1,000x. Like 1,000 square foot house would sell for $1 million. Maybe if you're like on the beach in California, or maybe it could be like 10x. Maybe a 5,000 square foot house would somehow only sell for $50,000 in like rural Texas if it's not made with very good materials. So you can see this like multiple that I'm using, value divided by square feet, which I just made up, is like a good way for us to compare houses, right? And in this area, houses seem to have like a multiple of 100x value to square foot. So this is kind of the entire principle of relative valuation. Relative valuation is just looking at other companies or assets similar to yours to find the value of your company. And then intrinsic valuation is just looking at your company intrinsically and focusing on those future cash flows. So I'll dive a bit deeper into intrinsic valuation, but I'll mostly be talking about it extensively in my next video. So to calculate the intrinsic value of a business, which is just the present value of the future free cash flows in enterprise value, we must project out a business's cash flows in the perpetuity, so forever, and discount them back to present value. So therefore, the main determinants of the value of a business are a business's potential cash flow growth and the riskiness of those future cash flows. These are the two main things that determine how I would value a business. If a business has cash flows that are likely to grow, then I would probably ascribe more value to that business than a business that has cash flows that are like probably just going to remain stable for the rest of the time. And then also risk is like a big factor in that. If a business has a lot of risk, those cash flows will be discounted at a higher discount rate than a business that doesn't have much risk. So now I'll talk about valuing a perpetuity, right? Because it seems kind of hard to like actually value out cash flows into forever, right? So I guess I'll give you a little example here. What is the value of the lemonade stand company that will produce $10 of cash flows every year in the perpetuity that has a discount rate of 10%? We must find the present value of all of these cash flows. So 10 plus 10 plus 10 plus 10 into forever, right? Because we're getting $10 each year. So the present value would just be what I'm doing here, 9.1 plus 8.3 plus 7.5. And of course, I'm using that same, present value formula of the cash flow divided by 1.1 to whatever year I'm discounting it by. So in the third year, it would be 10 divided by 1.1 to the third power, and that equals 7.5. So you can see here that this like infinite series is going to converge at a certain number, right? And just from this pattern, it sure looks like it's probably going to converge at about 100. The value of all of these, like 9.1 to 3.9 dot 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 dot, will add up to around 100. And that actually is the case. It would add up to 100 if we just projected this out to forever. And like around 200 years from now, these cash flows would start being worth like 0.00001 because they're just being discounted at such a high rate. And that's why they're just continually being worth less, right? It's the same principle of like, if I have $5 now and I invested it now, I could have $1 million in 50 years if I invested it smartly. Well, that $1 million in 50 years is only worth $5 now, just due to the principle of the time value of money, right? Valuing cash at different points in time. Cash in 50 years is really not much worth anything to us right now because we could just invest a small amount of money and get like a huge return because of compounding interest, right? And that's the entire principle of the time value of money. So the formula for valuing a perpetuity is actually, there's a formula for it. It's just cash flow divided by discount rate is the present value of perpetuity. So here it would just be 10 divided by 0.1, which would just be 100, right? So when valuing businesses, this is a bit more complicated, right? but the general principles are the exact same. And the form of intrinsic valuation that we typically use to value a company is called discounted cash flow, or DCF valuation. So this is really just projecting out all the cash flows for a business into perpetuity and then discounting them all back to present value. And obviously this is much more nuanced than this like simple perpetuity, because we're having to like factor in so many things, like all the different revenues a business will bring in, all of their costs, their interest, all the debt they have. There's just so many things you have to account for, which is why an intrinsic valuation for a company just takes so much work and it's just so complex. But this is just a general principle of how we get the present value of a perpetuity. If the cash flows were $200 a year and the discount rate was 20%, then it'd be 200 divided by 0.2, and the perpetuity would be worth 1,000. So that's just how you get the present value of a perpetuity. So now I'll talk about relative valuation. So this takes a lot less time than intrinsic valuation. So rather than doing all this analysis on just a single company and their cash flows, relative valuation is just looking at how similar companies are trading. And by trading, you look at multiples such as enterprise value to revenue or enterprise value to EBITDA, which typically reflect the same principles of intrinsic valuation, which is basically just cash flow growth and risk, right? If one company had EBITDA of, I'll talk about that at the bottom. If one company had EBITDA of 100 and an enterprise value of 2,000, and one company had EBITDA of 100 but enterprise value of only 500, there must be a reason for that, right? Why would the market be willing to pay so much more for one company's $100 of EBITDA? It must be because they expect that company's EBITDA to grow a lot in the future. Maybe the company is just less risky than the other company. Just these multiples, EV to revenue and EV to EBITDA, which we're doing relative valuation by, are using the same core principles of intrinsic valuation. So relative valuation, these metrics we're using still incorporate cash flows and risk. It's just kind of like a shortcut to do that. And for example, tech companies have high multiples since they're expected to grow a lot in the future, whereas industrial companies might have lower multiples. And yeah, this just goes back to that same example. Someone might be willing to pay a high premium for a tech company now because of like, oh shoot, if this company achieves network effects or something crazy and becomes the next Google, then I want to pay for it right now. I'm willing to pay a higher price for that company just due to the potential of it becoming really big, right? So someone will pay more for a tech company with 100 of EBITDA versus an industrials company with 100 of EBITDA because a tech company is more likely to grow. So it's still using these same mechanics of intrinsic valuation, but it's just like a shortcut to do it, right? And very similar to how I did the house, right? When I did value to square foot, which I got 100x, I think, then this is just very similar, using the value, EV, divided by some key metric like EBITDA or revenue. And I'll show how you do this in practice. So typically there are two ways to do a relative valuation, either looking at precedent transactions or doing a comparable companies analysis, which is also called comps. Precedent transactions looks at the multiples that similar companies were purchased at in M&A deals. So only deals that have actually gone through, like, oh, this company was bought for 10x EV to EBITDA in this M&A deal. And then comps is just looking at how similar companies are trading on the market right now. So if I'm like a business owner and I want to sell my company to someone, I might be more interested in precedent transactions because this is actually showing what they were actually bought for within M&A activity. And typically when there's an acquisition, the person that is buying that company will be willing to pay a premium because they're like buying the entire company and getting control of it. So typically, if you do relative valuation using precedent transactions, it will result in a higher valuation than doing it looking at comps, because comps are not baking in this like control premium. It's just looking at how similar companies are trading on the market right now. So I'll give a little example of how you would actually do this in practice. Let's say I'm trying to value Carter and I don't feel like doing an intrinsic valuation. I can say Carter has $1 million in EBITDA and has an enterprise value of 13 million. So its EV to EBITDA is just 13 divided by 1. So it's 13x. And there are three publicly traded companies that I deem comparable to Carter, whether they are comparable in size, industry, geographical location. It is deemed to be comparable to Carter. Of course, there are never two companies that are exactly the same, but you can try to find companies that are somewhat the same. So we could say company A, which has EBITDA of 500K and EV of 8 million, so its EV to EBITDA is 16x. Company B has EV to EBITDA of 12x, and company C has EV to EBITDA of 15x. So the average of these three is around 14x EV to EBITDA, which is higher than what my company is currently trading at. It's currently trading at 13x EV/EBITDA. So perhaps my company is undervalued. But of course, relative valuation is very shorthand. If we were to do an intrinsic valuation, we could be more confident with whatever valuation we get. Here, we're saying using this relative valuation, Carter should actually be worth $14 million of enterprise value. But really, there's probably a reason why Carter is trading at a lower multiple, right? Maybe it's because the company is just doesn't have as good of management, or it doesn't have as much growth potential, or maybe it just has an inferior product. So you can't just take this at face value, right? You need to do analysis on your own. But maybe if you just think a company is really good, and I do a lot of analysis on Carter qualitatively, and I'm like, wow, Carter is a much better business than all these other companies. I can't believe it's trading at a lower multiple. Then maybe you could make the argument that you should buy that stock. But just doing this alone is definitely not an argument for buying a stock. You can't just look at multiples and say, "Oh, my multiple's lower. That means it's undervalued." You have to do, more in-depth analysis on the actual company and the competitive dynamics in an industry. But this is just kind of how relative valuation would work. So yeah, in conclusion, enterprise value is the market implied value of a business's operating assets. So it's just a business's operating assets. It doesn't include non-operating assets and activities. Whereas equity value is the value of everything attributable to equity holders. So things coming from operating assets and non-operating assets, because non-operating assets can still result in cash generated, which could go to an equity holder. However, it's just not included in the value of an all-encompassing business, right? It's EV, or enterprise value, is just the business's core operating activities. And then, of course, intrinsic versus relative valuation. In my next video, I'll talk a lot about discounted cash flow valuation, which is like the main method we're doing to value businesses intrinsically. But yeah, until then, I hope y'all have a good day, and thank you.